Welcome to BAS 101 Market Macroeconomics. I am Adu-Osae, your supervisor and lecturer. This is week 8, and because of the Anzac holiday, we are running this week's lecture in two modes: the online and face-to-face. The online lecture is particularly for Monday students. After listening to this lecture, Monday students must complete the exercise that follows. This lecture is divided into 4 parts. Part 1 is on bond prices and interest rates. A bond is a financial asset or a security issued by a firm or government who wants to borrow money. The principal or the face value is written on the bond, and the buyer of the bond, who is the lender, would normally pay a price below the face value. The return on the bond is the interest rate or the coupon payments. In a nutshell, the seller of a bond is the borrower of money, and the buyer of the bond is the lender. So the lender demands the bond and the borrower sells the bond. In general, there is an inverse relationship between the price of the bond and the interest rate. Therefore, we can use the demand and supply model to understand bond and interest rate behavior. For the lender, the higher the price, the lower is the return, and so the lower is the quantity demanded. And the lower is the price, the higher is the return, and so the higher will be the quantity of bonds demanded. By contrast, for the borrower, the higher is the price, the lower is the borrowing cost, and therefore the higher is the quantity supplied. It follows then that the lower the price, the higher is the cost of borrowing, and therefore the lower is the quantity supplied. Let's use the 90-day Treasury bill as an example of a bond. Then the demand curve is downward sloping because of our previous explanation, and the supply curve is upward sloping. At the equilibrium is the quantity of bonds that is demanded and supplied, and that equilibrium price also will have a corresponding interest rate. And for example, if the price should drop from the equilibrium to P0, you will see that the quantity supplied will be smaller at Q1 and the quantity demanded would be at Q0. Therefore, there will be a shortage, and by our simple demand and supply analysis, we will see that the price would increase. We can show the inverse relationship also mathematically. If we just take here to be the price of the bond, and this is the interest rate, then the interest rate is just the difference between the price and the face value relative to the price of the bond. So let's assume that we have a bond of face value $1,000. Then if the buyer pays 950, the return would be 1,000 minus 950 divided by 950, and that will give us an interest rate of 5.3%. So we can see that as the price falls to 900, the interest rate will rise to 11.6. So as we saw earlier, the lower the price of the bond, the higher the interest rate. The buyer prefers a lower price, and the seller prefers a higher price. We can deepen our understanding of the relationship between the prices of bonds and interest rates by assuming that a typical investor will hold a portfolio of money and bonds. If the interest rate is below the equilibrium market price of money, then the quantity demanded of money will be greater than the quantity supplied, and therefore there will be a shortage. For the investor to receive more money, then they would have to sell some bonds. In so doing, that would increase the supply of bonds and shift the bond supply curve to the right, and hence increase the interest rate. In so doing, the price of the bonds would fall. Hence, there is always an inverse relationship between the price of the bond and the interest rate.